Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Tony Zhang, Chief Strategist at OptionsPlay, to discuss positioning in a market that's overextended and complacent. Tony, it's great to see you on this Options Expiration Friday. Welcome back to Trade Talks.
Thank you so much for having me. Looking forward to talking a little bit about the markets and the challenges that we have with trying to position in the current market extension that we're in.
Well, let's take a look at your first couple of charts, highlighting levels in the Nasdaq 100 and, of course, the growth versus value trade.
Yeah, so if we first take a look at whether we look at the S&P or the Nasdaq 100 index, we see similar markets from the perspective of recent breakouts above new all-time highs. If we look at the Nasdaq 100 recently breaking above that 12,500 level, it's really been slowly grinding its way higher without any significant pullbacks of more than 1 to 2% over the past 2.5 months. So markets are very complacent. If you look at put-call ratios, there's a huge disparity or skew on that side in terms of number of calls versus puts traded. Volatility still remains relatively high here without any pullbacks. A lot of investors are asking, how do you continue to position in this type of overextended and complacent market where you would typically look for pullbacks in this type of market? This is exactly how we started 2020, where we had multiple months of these slow grind moves to the upside with no real pullbacks here in sight. So a lot of investors asking how to position for this. So today we want to talk a little bit about how to look at the markets in the current market conditions, which again are overextended. And from my perspective, I think the big shift that we have to take a look at is something that we've been talking about for years, which is the rotation from growth to value. Growth has obviously outpaced value by a substantial margin over the past few years, but over the last 4 or 5 months, we have seen value, number one, keep pace with growth and actually start to outpace growth a little bit here over the past two months, especially since the Pfizer and Moderna vaccine were approved. And if we look at the chart of value to growth, we see this very nice bottoming formation, an inverted head and shoulders formation that recently just broke above the 200-day moving average. So from my perspective, technically speaking, this looks like this could be the start of a much larger shift or much larger rotation out of growth into value going forward. And this could have some ramifications for high beta sectors like the Nasdaq 100 versus IWM, some of these small cap sectors.
Are you seeing anything with the Nasdaq Volatility Index Vol Q that traders should be aware of?
Yeah, absolutely. So I would say the one major difference between what we have seen at the beginning of 2020 and the beginning of 2021 is that even though the price action of the markets between the two are very, very similar to each other, the volatility markets are vastly different. Volatility right now is trading at more than double where it was back in January of 2020. So investors are on alert. Investors are concerned about future volatility, and not just over the next 30 days. If we look at Vol Q, which is a measure of the Nasdaq 100 at the money, implied volatility is going on 30 days. But if you look at the term structure, if you look at the futures going out 2 to 3 months, they're elevated as well. This tells us that investors, they're not asleep at the wheel, which we feel that investors were back in February at the start of the coronavirus. Volatilities were very, very low. Traders had mispriced the potential movements in the broader markets here. Right now, investors currently are expecting plenty of volatility in the next few months.
I think the other cause for concern is the way the data is moving. It's not improving quite yet.
Yeah, exactly. So if we look at the economic data, certainly there has been slowdowns across the board, whether you look at consumer confidence, employment numbers. We just got the new Bloomberg consumer confidence numbers. They continue to decline here in December. Same thing for employment claims, continue to see an acceleration to the upside in short-term weekly initial claims. Job growth has slowed down. So all across the board, economic indicators are decelerating. Now, I will say that we can potentially look at that as more of a contrarian indicator at this point, because especially with the Biden administration, and now what you have is a Democratic sweep, you have potentially the opportunity to pass far more stimulus for the coronavirus as a result of this slowdown that we're starting to see in the economic activity. And this has I would say, in my opinion, a higher probability of a larger stimulus bill being passed as a result of these economic indicators slowing down. So I do think to some degree, bad news is good news here for the equity markets when we see the employment and economic numbers slow down.
We have heard that story before. Bad news is good news. Tony, let's take a look at the 3 trades you have this afternoon. This time we'll start with the transport.
Yeah, so I want to take a look at certain segments of the market that have been doing quite well, and as a result of the coronavirus have seen accelerations to the upside. And transports and railways certainly sit at the intersection of that, as shipping containers from all over the world come to the US, need to be distributed around the country. Railways have actually been doing quite a bit of that work alongside trucks. So UNP reports earnings next week, a way to kick off the earnings season next week. UNP recently breaking above that $210 resistance level, coming back to retest that as support over the past couple of days. And that is the opportunity that I see with next week's earnings as the catalyst for UNP to trade substantially higher here. So the trade structure I'm looking to use takes advantage of the elevated implied volatilities that we see going into the earnings announcement by selling the February 26th, which is a weekly option, selling the 215, 210 put credit spread here. This is a $15 wide credit spread that we're collecting about $5.40. So a little bit more than 1/3 of the width, which is typically what we seek to collect on a trade like this, and will be profitable as long as UNP stays above 215 between now and the expiration date of February 26.
And Twitter and all social media platforms have certainly been getting a lot of attention since the insurrection on Capitol Hill, January 6th. Is this a knee-jerk reaction? How would you trade that?
I certainly think it is. For the stock to be down 15, 20% from the news of that alone, especially of removing of Donald Trump as a user, I don't necessarily see a 15 to 20% decline in revenue or earnings as a direct result of that. So I do think that this is a bit of a knee-jerk reaction, that when you have higher implied volatility, another opportunity to sell volatility and not chase stocks at all-time highs. I think that's one of the key things about how to position for this particular market, is finding opportunities like this where perhaps markets sold off a little too heavily, especially with elevated volatility. Take advantage of that. So we're selling similar trade structure here going out to February 26th as well, selling the 45-40 put credit spread, a $5 wide credit spread here, collecting $2.10, which is more than 40% of the width here. So this is where we've found an extreme positioning in the markets provides an elevated premium that we're able to collect, which reduces our risk on the overall trade. And this will be profitable as long as Twitter stays above $45 between now and February 26th.
And our last trade is in GM. What a story that has been for the entire EV sector. It's such an exciting place to be right now.
Exactly. So this is probably the number one request we get from clients these days, is electric vehicles. And if you look at the space, everything from Tesla to NIO to XPeng, these are stocks trading at eye-watering valuation. And it's really difficult to wrap your head around. You're either a short-term speculator, like a day trader in some of these stocks, or you're a long-term investor. And I think for those long-term investors looking to add electric vehicles in their portfolio, GM certainly is one to pay attention to. So for GM recently breaking above its all-time highs since the bankruptcy, this signals to me that there's been a shift in how investors are looking at GM, not just as a car manufacturer, but really focused on electric vehicles. And they've made quite a few different bets around hydrogen fuel cell, battery technology, really kind of throwing the kitchen sink at this problem of moving away from internal combustion engines. And I think it's a great story. And I think the breakout here is worth trading. So for this, I'm going to use a debit vertical spread here, try to take advantage of more upside here, especially in some of these electric vehicle names. We've seen some big moves to the upside over very short periods of time. Using a debit spread allows us to take advantage of that. So for this, I'm going out to March, and I'm buying the $49.60 call debit spread here, paying about $3.15 for this $11 wide debit spread, allowing us to risk only $3 to potentially make upwards of about $8 on this particular trade.
And finally, Tony, how can Trade Talks viewers get in touch with you?
So we have a great 30-day free trial for everyone who wants to take a look at the education, the technology platform, and the ideas that we share with investors. And you can sign up for that at trade.optionsplay.com/trade talks.
All right, Tony, great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.